There is one year in your life where two separate cliffs overlap and they pull in opposite directions. That year is the year you turn 63, and one of those two cliffs came back into existence in January after being switched off for 5 years. So if you looked at this in 2023 and made a plan, that plan is now built on a rule that no longer exists. Here is the trap in one sentence. At 63, you are very likely buying your own health insurance because Medicare does not start for 2 more years. That insurance is subsidized, and the subsidy now disappears completely at a hard line, and the line is about $62,600 for one person. And at the same time, your income that year is what sets your Medicare premium when you enroll at 65, because Medicare looks back 2 years. 2 cliffs, same year. And here is what almost nobody has noticed. They are not at the same height. The Medicare line sits at $109,000. The health insurance line sits at $62,600, which means for a great many people at 63, the Medicare threshold everybody talks about is not the one that will hurt you. It is the second one, sitting at barely more than half the height, and it went back into force 9 months ago. And the third thing pulling at you is the tax system, which is telling you the exact opposite. Your bracket is nearly empty at 63. Every article you have read says convert while your income is low. So one system says push your income up, 2 systems say hold it down, and they disagree about how far down. There is no arrangement that satisfies all 3. Every choice you make at 63 costs you something in one of them. The only genuinely wrong move is not knowing you are choosing. Before I start, I am not an accountant, and this is not tax advice. These are general rules with real figures, and your own numbers will differ in ways that matter. Every item here deserves a conversation with a professional. My name is Kevin. I read the boring documents so you do not have to sit with them. If that is useful, subscribe and turn on the bell, because the second half of this video covers the version of this that hits a surviving spouse, and it is the harshest arithmetic in the entire system. So, the cliff that came back. Let me be precise about it, because this is new and most coverage of age 63 predates it. If you retire before 65 and buy coverage on the marketplace, your premium is reduced by a credit based on your income. For 5 years, from 2021 through the end of last year, that credit had no upper cutoff. Above a certain income, the help shrank gradually, but it never vanished, and nobody paid more than a set percentage of their income for a benchmark plan. Those enhanced rules expired on the 1st of January this year. Congress did not extend them. What returned is the original structure, and the original structure has a hard edge at 400% of the federal poverty level. For coverage this year, that works out at roughly $62,600 for one person and roughly $84,600 for a couple. Below it, the credit works on a sliding scale. $1 above it, the credit is 0. Not reduced, 0. And here is what makes it worse than an ordinary threshold. If you receive the credit during the year in advance, which is how nearly everybody receives it, and your income ends up above the line, you repay it. All of it. On your tax return. So somebody who took a large withdrawal in November can owe back a full year of health insurance subsidy in April. Let me put the actual figures on it, because the size of this surprises people. An analysis by the Kaiser Family Foundation found that a 60-year-old with an income of $62,000 pays around $515 a month for a benchmark plan. The same 60-year-old with an income of $64,000 pays around $1,244 a month. $2,000 more of income, roughly $8,700 more in premiums across the year. That is not a tax rate. There is no bracket in the code that behaves like that. $2,000 of income producing nearly $9,000 of cost is a marginal rate of over 400% on that slice. And it lands hardest on exactly this audience, for a reason that is worth knowing. Insurers are permitted to charge their oldest customers up to 3 times what they charge their youngest for the same plan. So the unsubsidized premium for somebody in their early 60s is enormous to begin with, which makes losing the subsidy far more expensive than it would be for somebody at 40. For a couple in their early 60s, unsubsidized coverage in many markets runs past $20,000 a year. And I want to name exactly who this reaches, because a lot of people watching will assume it is not them. It is anybody who retired before 65 and is buying their own coverage. That is a very large group, and it is growing, because the average retirement age keeps drifting earlier than 65, while Medicare has not moved. It is anybody whose spouse retired first and put the household on a marketplace plan. It is anybody who left a job and took coverage through the marketplace rather than continuing an employer plan, which is frequently the cheaper option and frequently the right one. And here's the part that catches people who think they are safe. This is not about being wealthy. The line is $62,600 for one person. A modest pension, a small amount of investment income, and one withdrawal to cover a car or a roof gets you there without anybody feeling remotely well off. That is genuinely the thing I want to land before I go further. Every other threshold I talk about on this channel sits at a level most people watching will never reach. This one does not. This one is sitting right in the middle of an ordinary retired household's income, and it went back into force 9 months ago. Orlan is 63, and he did everything the articles told him to do. He retired at 61 after 34 years at the same firm. He had read about conversions for 2 years before he retired, and he understood the logic properly. Low income now, low bracket, move the money while it is cheap. So this spring, he converted a substantial amount from his retirement account, deliberately, having checked his tax bracket first. He checked one thing. He checked the bracket. He is on a marketplace plan because he is 2 years from Medicare, and the conversion took his income over that line, which means the subsidy he has been receiving all year is now repayable, and he will find that out in April. The conversion may still have been the right decision over 20 years. That is genuinely arguable. What is not arguable is that he made it having looked at one of the 3 systems and not the other 2, because the only one anybody had explained to him was the bracket. That gap between checking the number everybody talks about and checking the 2 nobody mentions is exactly why the quiet rules exists. Not clever strategy. The 3 lines that matter at this specific age, written plainly and in large print, so that a decision made carefully against one rule is not quietly wrecked by 2 others nobody named. Reading it cost you 1 afternoon before you move any money. Not reading it cost Orlan a year of health insurance he thought was already paid for. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not put something in your hands you did not already have, send it back. Now the second cliff, and this is the one everybody covers, so I will be efficient about it and then tell you the part that gets left out. Medicare premiums are not the same for everybody. There is a standard amount, and above certain income thresholds there is a surcharge on top. The standard Part B premium this year is $202.90 a month. The first threshold sits at $109,000 for a single person and $218,000 for a couple. Cross it, and the premium moves to $284.10. At the top of the scale, it reaches $689.90 per person per month. It is a cliff rather than a slope. $1 over a line moves you into the entire next tier, and it uses your income from 2 years earlier. Which is the whole reason 63 matters. Your income at 63 sets your premium in your first year of Medicare at 65. Now here's the part that gets left out, and it changes what you should actually do. Compare the 2 heights. $109,000 for Medicare, $62,600 for health insurance. If you are on a marketplace plan at 63, the Medicare threshold is not your binding constraint. It is nearly twice as far away. You will hit the health insurance cliff long before you get anywhere near the Medicare one. So for that group, and it is a large group, all the advice about managing income to stay under the Medicare threshold at 63 is aiming at the wrong line entirely. The exception is somebody at 63 who is not on a marketplace plan. Retiree coverage from a former employer, a spouse's plan through their job, coverage through a union. If that is you, the health insurance cliff does not apply and the Medicare threshold becomes the real one. Which means the first question at 63 is not how much can I convert. It is, where does my health insurance come from? Because that answer determines which cliff you are actually managing. 2 different people, both 63, both with the same account balance, can have correct answers that differ by $50,000 of income, purely because of where their insurance comes from. And almost nobody frames the question that way. There is one more feature of the Medicare threshold worth knowing because it is the reason people get caught twice rather than once. The surcharge is not a one-year event. Your income at 63 sets your premium at 65. Your income at 64 sets it at 66. So a person who has one large year at 63 pays for it once, but a person who spreads a large conversion across 63 and 64 pays for it twice, in 2 consecutive Medicare years, which produces a counterintuitive result. Splitting a conversion across 2 years is usually the right move for tax brackets and for the health insurance cliff. But if both halves still land above the Medicare threshold, splitting has doubled the number of years you pay the surcharge rather than avoiding it. So the correct answer depends on whether splitting actually gets you under a line or merely reduces how far over you are. Under the line is worth everything. Slightly less far over is worth nothing at all, because it is a cliff and not a slope. That distinction is the single most common modeling error I see described in emails, and it is entirely avoidable if you know to ask the question. Now, the third system, and I want to be fair to it because the advice is not wrong. 63 sits inside what planners call the gap years. Retired, not yet claiming Social Security, no forced withdrawals yet. Income at its lowest point in decades, and the tax brackets nearly empty. That genuinely is the cheapest moment to move money out of a traditional account. The logic holds. Every dollar moved at a low rate now is a dollar not coming out at a higher effective rate later. The problem is not the advice. The problem is that it is complete as tax advice and incomplete as retirement advice, because the tax on the conversion is only one of 3 prices you pay for that income. And the other 2 are not taxes at all. One is an insurance premium. One is a Medicare premium. Neither appears anywhere on a tax return, which is precisely why a tax professional focused on the return can give you flawless advice that still costs you money. And there is a 4th pressure at 63 that nobody counts as a system, but it behaves like one. Social Security. You can claim from 62, which means at 63, the decision is live and sitting in front of you. Claiming adds income, permanently, starting immediately, which means it counts toward the health insurance cliff every single year until Medicare starts, and it counts toward the Medicare threshold from 63 onward. So for somebody on a marketplace plan, claiming early does not simply reduce the monthly payment for life, it can also push them over an insurance cliff in every remaining year before 65, at a cost that can exceed the benefit payments themselves. That is not an argument against claiming early. There are entirely legitimate reasons to claim at 62 or 63, and needing the money is the best of them. It is an argument that the claiming decision and the health insurance decision are the same decision, made once, and almost nobody presents them together. The claiming question is usually answered by a Social Security calculator that has no idea what your health insurance costs. So if you are weighing when to claim and you are on a marketplace plan, the honest version of that calculation has to include what claiming does to your subsidy for the years between now and 65. For some households, that changes the answer entirely. Roena is 63, and her situation is the one that keeps me up, because she did not make a decision at all. Her husband died 14 months ago. She is on a marketplace plan, and she has been managing, carefully, on a budget she worked out at the kitchen table. In March, she sold some shares. Not to be clever and not as a strategy. The roof needed replacing, and that was where the money was. And I want to sit on that for a moment, because her situation is far more common than the deliberate planner, and it gets almost no coverage. Nearly every article about age 63 is written for somebody executing a strategy, somebody with an advisor, running conversions, weighing brackets, making choices. That is not who most people are. Most people at 63 are solving problems as they arrive. A roof, a car that finally died, a grandchild's tuition, a medical bill, helping an adult child through a bad year. And every one of those is funded from whichever account has the money in it, which is very often the retirement account, because that is where the money is. So the income event is not a decision anybody weighed. It is a roof. And the system reading that number cannot tell the difference between a person optimizing their tax position and a person replacing shingles before winter. Which is why the thing I most want you to take from this video is not a strategy at all. It is simply that before you take money out of a retirement account for any reason, including an entirely ordinary one, there is a question worth asking about which account it comes from. Because the same roof paid for out of a savings account or a tax-free account does not touch any of these lines at all. Same roof, same money, different account. And nobody ever mentions that the account matters. Nobody told her that selling shares would touch her health insurance. Why would it? She was solving a roof problem. And there is a second thing coming for her that nobody has mentioned either, and it is worse. While she was married and filing jointly, the Medicare threshold that will eventually apply to her was $218,000. Filing alone, it is $109,000, half. Her income did not halve, the line did. That is precisely what the guide is built for. The thresholds that move when your circumstances change, written plainly and in large type, so that a woman fixing a roof in the worst year of her life does not discover in April that she owes back a year of health insurance. For somebody in Rowena's position, the cost of not knowing is measured in thousands, arriving in a spring she is already dreading. Same place, kevinexplains.shop. The link is in the description and in the pinned comment, and the code is on your screen if you are watching on the television. 7-day guarantee every single time. A widow solving a roof problem, about to be billed by a system she has never heard of. So let me stay with that because it is the harshest arithmetic in the entire subject, and it is coming for a very large number of people watching this. When one spouse dies, the survivor files as a single person from the following year onward. Every threshold halves. The Medicare line goes from $218,000 to $109,000. The health insurance line goes from roughly $84,600 to roughly $62,600. The tax brackets compress, and the standard deduction drops. The household income does not halve. A pension continues, investment income continues, and the survivor keeps the larger of the two Social Security payments, so that does not halve either. So a household that was comfortably below every line while there were two of them can be over several of them with one, having changed nothing about how they live. This is the widow penalty, and it is not a policy anybody designed. It is what happens when a system built around two filing statuses meets a household that just became one. And here is why I am raising it in a video about 63 specifically. The protection against it is built before it happens, and the years around 63 are when most couples still have both people and both sets of thresholds. Money moved into a tax-free account while you are both alive is money the survivor can draw on later without it touching any of those lines. Every dollar sitting in a traditional account is a dollar that will eventually come out and be counted against thresholds that are half the size. So for a married couple at 63, the joint thresholds are an asset with an expiry date that nobody can predict. That is an uncomfortable way to think about it, and it is the honest way. And there is a second protection for a surviving spouse that almost nobody knows about, so let me give it to you properly. In the year your spouse dies, you may generally still file jointly for that entire year. So the joint thresholds apply one final time for the whole of the calendar year in which the death occurred. That is not a small thing. It means there is a window, frequently several months long, in which the wider thresholds are still available, and it closes on the 31st of December. And for somebody with dependent children at home, there is a further filing status that can extend favorable treatment beyond that year, though that applies to a small number of people in this audience. Now, I know precisely how this sounds. Nobody wants to hear that the months after losing a spouse are a planning window. It is a genuinely uncomfortable thing to say, and I have thought about whether to say it. I am saying it because the alternative is that people find out in the following spring when nothing can be changed, and I would rather be uncomfortable now than useless then. So if you are helping somebody through this, or you are the person going through it, the practical version is short. There is one tax year where things are still calculated the old way. Anything that needs to happen, a sale, a withdrawal, a conversion, is meaningfully cheaper inside that year than after it. It does not have to be dealt with in the first weeks. It does have to be dealt with before the year ends. And there is one more thing that catches survivors and has nothing to do with thresholds at all. Your own Social Security payment changes. The household drops to one payment rather than two, and it keeps the larger of the two. So income falls at the same moment the thresholds have, which is the worst possible combination, and it happens automatically without anybody having to decide anything. Which is the argument once again for the years around 63, when both people are still here and both sets of thresholds still apply. Now, the appeal, because everybody asks and there is a specific answer. There is a form for asking Medicare to use a more recent year instead of the 2-year-old figure. It applies when a qualifying life-changing event caused your income to fall. The recognized events are marriage, divorce, the death of a spouse, stopping work, reducing work, loss of income-producing property through a disaster, loss of pension income, and an employer settlement payment. Notice what is not on that list. A conversion you chose to do is not a life-changing event. Selling shares because you decided to is not one. A decision you made deliberately does not qualify, no matter how much you now regret the timing. But look at that list again from the other direction, because there is genuine relief in it for the right person. Stopping work is on the list. So somebody who retired in a year with a full salary and is now facing a Medicare surcharge 2 years later based on that salary can file this and have it recalculated. That is enormously common and hardly anybody does it. The death of a spouse is on the list. So is losing a pension. So the rule is simple. If your income fell because something happened to you, file it. If your income was high because of something you chose, it will not apply, and time will fix it on its own as the look back moves forward. Now let me give you the thing that lowers both cliffs at once, because there is one and it is underused. If you are over 70 and a half, giving directly from your retirement account to a charity keeps that money out of your income figure entirely, not deducted, never counted. The limit this year is $111,000 per person. That does not help somebody at 63, and I'm not going to pretend it does. But it is the tool for the years after, and it is worth knowing exists now, because it changes how much you need to move earlier. For 63 specifically, the levers are different, and they are mostly about timing rather than avoidance. Splitting a conversion across 2 calendar years instead of 1. Selling an asset in December of 1 year, and the remainder in January of the next. Funding a large expense from a savings account or a tax-free account rather than a traditional one. Contributing to a health savings account if you are on a high-deductible plan, because that reduces the income figure both cliffs read. None of that is exotic. All of it is scheduling. 2 more practical things before my read on it, because they are the ones that actually get used. The first is that the health insurance cliff can be managed after the fact in a way the Medicare one cannot. Certain contributions reduce the income figure the marketplace reads, and they can be made after the year has ended in some cases. A health savings account contribution, if you are on a qualifying high-deductible plan, is the main one. And for somebody sitting slightly over the line, it can pull them back under and restore an entire year of subsidy. That is worth knowing in February, when you can still act on it, rather than in April when you cannot. So if you have any suspicion you may be near that line, the conversation to have in January is whether anything can still be contributed for the prior year. The second is about paying back a subsidy, because people panic about it, and the panic is worse than the situation. If you do end up over the line and owe the credit back, that is a balance on your tax return like any other. It can be paid over time through an arrangement rather than all at once. It is expensive and it is not a catastrophe, and the worst version of it is the person who is so frightened of the letter that they do not file at all. And one more thing worth saying to anybody who is now worried they have already crossed a line this year. 9 months of this year have gone, which means 3 remain, and a great deal of what determines your final figure has not happened yet. A withdrawal you were planning for November, a sale you were considering, a conversion you had penciled in for December, those are all still yours to decide. This is not a video about something that already happened to you. For most people watching, the year is still open. So where do I come out on all of this? The thing I keep returning to is that none of these 3 systems knows the other 2 exist. The tax code does not care what your health insurance costs. The marketplace does not care what your bracket is. Medicare does not care about either and is looking at a figure from 2 years ago. 3 separate systems, 3 separate agencies, reading one number about one person, none of them talking to each other. And the only place all 3 meet is inside your household, which means there is genuinely nobody whose job it is to give you a complete answer. A tax professional gives you correct tax advice. An insurance broker gives you correct insurance advice. Neither is wrong and neither is complete, and the gap between them is where the money goes. And on the subsidy cliff returning specifically, I will say this plainly and then stop, because it is a live political question and both sides have a real case. Whatever anybody thinks about whether those enhanced credits should have continued, an enormous number of people made multi-year plans under one set of rules, and the rules changed on the 1st of January. That is not a criticism of the policy, it is an observation that the people affected are largely unaware because the change was covered as a national story rather than as a letter to them. So here's what to do, and it is 5 things. 1. Answer the insurance question first. Where does your health coverage come from right now? If it is the marketplace, your binding line is around $62,600 single or $84,600 for a couple, and it is far lower than the Medicare one. If it is retiree or spousal coverage, the Medicare line at $109,000 is the one that matters. 2. Find your modified adjusted gross income from last year's return and write it down next to whichever line applies to you. That single comparison tells you how much room you actually have. 3. Before any discretionary income event this year, and that means a conversion, a sale, or a large withdrawal, check it against that line rather than against your tax bracket. The bracket is the least expensive of the 3 prices. 4. If you are married, understand that every threshold in this video halves for whoever is left. That is an argument for using the joint thresholds deliberately while you have them. 5. If you are already paying a Medicare surcharge and your income fell because you retired, lost a pension, or lost a spouse, there is a form for that, and it works. Most people who qualify have never heard of it. And if you are looking at your own numbers and cannot work out which of the 2 lines is actually binding on you, email me. The address is on your screen and in the description below. Tell me where your health insurance comes from and roughly where your income sits, and I will tell you which threshold you are actually managing, because for most people it is only one of them, and knowing which one makes the whole decision simple. Orlan checked his tax bracket carefully, and it was the least expensive of the 3 numbers he should have checked. Roena sold shares to fix a roof, and is about to be billed by a system nobody has ever explained to her. In a year she is already struggling through. Neither of them was careless. Both of them were doing something completely reasonable, in a year where 3 separate systems were watching one number, and none of them had sent a letter. And that is really the whole of it. Nothing in this video asks you to become a planner or hire anybody or understand a system. It asks you to find out where your health insurance comes from and then look at one number against one line. So find your line, one number from last year's return compared against one threshold that depends entirely on where your insurance comes from. 20 minutes at a kitchen table before December, while every one of these decisions is still yours to make. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.